And it's 9 o'clock. Good morning, everybody. Welcome to this post-budget panel discussion. My name is Oliver Dixon, and I will be your moderator for this session. We've got an interesting panel coming up for you, and we would like you to engage with it as much as you possibly like, ask as many questions as you can. But this panel discussion is going to have an interesting slant to it. We're going to focus primarily on the impact that this budget has on you as an individual, your household. We're going to have a discussion about the impact this budget will have on institutions, such as the businesses that we work with, such as the government institutions, local governments in particular. And we're going to have a chat about what that means for the economy in the short to medium term, and really what the key takeaways are that make the most impact in our lives. And we would like you to ask as many questions as you possibly can. This conversation is as much for you as it is about the panelists in this discussion. So your contributions matter just as much. Like I said, my name is Oliver Dixon, and you can participate in this conversation. Look, if you're going to be tweeting about this, posting on Instagram, just tag Old Mutual and just hashtag budget speech 2022, and we'll be able to track all of your engagement on social media. I'd like to introduce you to my panel, and then I'll give them each just 1 minute to talk about what it is that they do before we begin the conversation with the key talking points. I'd like to introduce you to John Manyike, affectionately known as Buzz John. It may not be the first time you see his face. He's quite the popular guy of late, trending on Twitter every other week, helping South Africans not blow it, being a common feature on popular TV program, I Blew It. John Manyike, or Buzz John, if we'll be calling him that, is the head of financial education at Old Mutual. And then I want to introduce you to Michelle Acton. She's a key account manager at Old Mutual. I spoke to Michelle a few days ago and I asked her, what does that mean? What do you actually do? She gave me an answer, but I can't tell you that I actually know anything. She still, hopefully this time around, it will be an answer that, my non-financially inclined self can understand. Michelle is from Old Mutual as well. And then we're joined by Dr. Lado Stander, who's the Divisional Head for Economic Intelligence in the Office of the Executive Mayor of the City of Tshwane. A mayor that's become quite popular, I would say the most popular mayor and the most popular city in the country at the moment, switching off lights left, right, and center, and dishing out 621,000 Rand fines to everybody connecting illegally. Dr. Stander told me the sheer amount of money that they were able to collect through that operation. Everybody here would be familiar with it. It's called hashtag Tshwane Team. In the mind, the figure will blow your mind. I promise you that. I'll ask him about it later again. Dr. Stander, being from public service, has an interesting take on what the budget means for service delivery. At more conceptually, but more granularity at his City of Tshwane division and what that means for their ability to function. These are our panelists today, and I hope you can engage with them and ask them questions. These are expert panelists in their respective fields. So make sure that you ask in-depth questions. Ask them the hard questions, because we may not have an opportunity like this for quite a while. John, I'll start with you. Just give us a minute and just tell us what it is that you do and your contribution towards the financial well-being of South Africans.
Thank you, Oliver. So as head of financial education at Old Mutual, my job really is to educate people about finances. I think, in all honesty, a lot of us were never taught how to manage money at school. I mean, if there's anything that I've learned at school, were the body parts of a locust. In fact, I used to ace that diagram, where they say, give a defined body parts of a locust, and then I knew the compound eyes of a locust. I didn't know compound interest. So that's a difference. So a lot of us are in that space, and neither did we have any money discussions in our families. It was such a taboo subject. I mean, parents never discussed money issues. I only saw my father every time my mother asked for money. He used to say, he will give a 50 rand and say, this is the last one. I mean, even if he said that 10 times in a month, but it was always the last one to show that it was never a good topic to talk about. So what I do is just basically talk to people about money and use a very simple language, because sometimes we can talk over people's heads. And that's what I'm passionate about, simplify money issues as much as we'll try our best to simplify this budget speech to what it means to an ordinary man out there. Thank you.
That's quite interesting. I had the same experience with my parents, really. In my family, we ran a spaza shop, and so my dad could not say this is the last money, because like, but I saw you count the money at the end of the day. But there were some other creative tactics they had to tighten the belt, so to speak. Michelle, thank you so much to yourself for joining as well. Can you just tell us what it is you do that South Africans take benefit from as far as financial fitness is concerned?
Great, thanks, Oliver. So essentially, I work within the Old Mutual Corporate Division. I specialize in the retirement fund space. I'm an actuary by training, but I spend quite a bit of my time firstly representing Old Mutual in a number of these industry bodies, especially around the retirement reform and the discussions that have been happening there. I've also been a retirement fund consultant and essentially advising employers and retirement funds on how best to manage their money. And I work in the distribution team to help spread the message of the products Old Mutual's got and how they can best be sold for our clients and potential clients.
And by the looks of it, you guys got some of the best products out there.
I'm slightly biased, but I think so, yes.
That's fantastic. Thank you so much, Michelle. Dr. Stander, your turn. We know government delivers services, but we're not quite sure what the head of, divisional head of financial intelligence does in the office of an executive mayor. That might need some explaining.
Morning, Oliver. So essentially, we are mandated with providing the executive mayor and our political principals with economic intelligence. So we focus on the economic trends that prevail throughout the globe, especially in capital cities. And we try to make sense of what we see happening around us. Economics, and why I'm interested in economics is because it really deals with how people make their decisions. And I'm quite sure John and Michelle will attest to our saving decisions in this country not being great from a consumer perspective. And very much similar to John, I love to simplify economic matters for people, which includes our politicians in the city of Tshwane. I was laughing when John said his father used to say, that's the last one. It's almost like Minister Godogwane to our state and enterprises saying that's the last one, right? And I hope they heed the call.
Look, here's where I want to start the conversation. Last night, yesterday afternoon, Minister Godongwane, went on and on about how he's putting money back into the pockets of consumers and households. And this is not the first time we heard this, right? His predecessor, Minister Tito Mboweni, had the same sort of tune he sang with his last two budget speeches, where it's like, we're in the middle of a pandemic. The important thing is for us to put as much money into the hands of the people as possible. And the word in government they use for this is stimulus. We're stimulating you as the citizen, as the consumer, as the taxpayer, to spend more money. But to do that, you need to have more money. John, you often advise people to save more money. Let's start there. What is firstly, there's no increase in tax, so to speak, right? Personal income tax stays sort of right where it is, but the floor has been lifted in terms of what the minimum threshold is for taxpayers. It's now sitting at 91,000 Rand per annum. It means a lot of low-earning households and low-earning workers find a little bit of reprieve over there, meaning that that they can have a little bit more disposable funds. I don't know what that looks like in nominal terms, but and there's this conversation around the fact that businesses, corporate income tax has not been hiked either, hoping that businesses are open towards giving their employees above inflation increases in their salaries. We hope for that. And all of these sorts of things around how the non-movement on tax puts more money in the hands of the people. I want you to start there and talk to us about that. What about that message made sense for you, if any at all? And is it something? Is it a positive step in the right direction for households and individuals?
No, absolutely. I honestly believe this was a consumer-friendly budget, in a sense that by literally keeping the tax rates the same, even though he basically broadened the income tax brackets, but he could have collected an extra 13 billion or so if he had gone on to actually impose an increase. But then, but also with fuel levy, it means he could have collected an extra about 3.5 billion rand. So instead, so literally, it means he's actually given that back to households, and which is a good thing. But also, if you have to consider the fact that the Reserve Bank has already started increasing interest rates, because they have a different mandate compared to government, because they have a monetary policy to look after, whereas government is responsible for the fiscus. So basically, it means the Reserve Bank, controls the inflation by simply using the interest rate as a tool. So because the central bank is starting to increase because they are managing inflation. So when government says, okay, we're not going to impose, more tax increases, it's a good thing for us, because then you can imagine if there was an increase in tax and on the other hand, interest rates are going up, it was going to put more pressure on already distressed, financially distressed households. So that's a good thing. And secondly, the fuel levy means, again, it's sort of balancing out what is likely going to happen. We're seeing what's playing out in the developments between Ukraine and Russia. So when those countries fight, I mean, these are the boss of the game, so they are the ringleaders, as far as oil, so Brent crude is starting to react to what's happening between Russia and Ukraine, and you're seeing there's a likelihood that fuel might be more expensive because of those global developments. So again, by not imposing a fuel levy means that will at least cushion the blow for many households. So again, that's a positive from a consumer point of view. But it means when you have this reprieve, you cannot just relax and start overspending. You have to be very cautious. All of us actually have to be cautious. As much as we know what the budget says, but we need to be cautious with our spending. It's not a time to be accumulating too much debt now, because anything can change anytime.
That's very interesting, because sort of the idea is that the reprieve, just sort of allows me to catch my breath a little bit, right? And it means that I can repay some of my debts, fix whatever debt issue I may have, and go forward from there. John, before I move on, I just want to circle back around the whole tax issue, right? And there wasn't much of a conversation around the size of the tax base in South Africa, which has in previous years been a big conversation, especially when there's anxiety about tax increasing. The argument from economists is always, if you increase tax, Minister, specifically personal income tax, you're going to decrease the tax base for some reason, and I wasn't always sure about the math behind that statement. But that sort of anxiety didn't exist this time around. A staggering number that came out yesterday was that 46%, nearly 50% of South Africans depend on some form of social welfare, being a monetary form of social welfare being put directly into their hands. To me, that means that 50% of South Africa takes care of the other 50%, quite frankly. What did that number mean to you, that 46% of South Africans being on social welfare, especially as a taxpayer, thinking about your own debt and some of the money you might be able to free up with this non-tax movement, if you consider inflation and whatever income increase you may receive, hopefully above inflation. Do you feel as though some people are being left behind in favor of you as a working class South African just finding a little bit of reprieve?
Look, I think that number for me, I mean, if you look at the number of people who depend on social grants, that budget is not sustainable. I think not only in South Africa, but even other countries around the world are looking for ways to cut back on social spending. But again, we have to appreciate the realities in South Africa, that we are a country with high income inequality, record levels of unemployment. So when you're dealing with these realities where there's high levels of poverty and a lot of people relying on the state is obliged to do something. Now, the question is, when you've got arguably a shrinking tax base, albeit maybe improving a little bit, is that it puts a lot of pressure on the few who are actually paying tax. That's why there is now a debate on whether shouldn't government be taxing the wealthy more? Shouldn't government be taxing corporate more? But again, the minister had to walk a very tight financial rope here, in terms of his balancing act, because you also don't want to be at loggerheads with the private sector, because the same private sector that the US government are saying that they need to help in creating jobs. Now, there can be a backlash, from business to say, but you want us to help support job creation, but at the same time, you're not being kind when it comes to corporate tax. So there was certainly a need to balance that, but I think we need to continue to monitor that number. Interestingly enough, I was on a call last night with Ukhozi FM, and majority of the people who were calling in were talking about the 350 rand. I mean, remember these are people at the grassroots level. So, in that 40-minute discussion, they kept saying, well, we need this 350 rand. And there was a lady that called, and you could see she was an elderly woman. And she was saying, this is the 350 I survive on, to buy bread because I am unemployed. But then, interestingly enough, there were other views from other people who were saying, yes, we see the need for the 350, but what if government were to take this pool of the 350 rands and used it to actually create jobs by supporting small businesses? I thought that was a brilliant comment from a listener, of that show. So again, we need to start thinking creatively around how do we fund our social grants. So we have to find creative ways, because I think just handing out money, you don't throw money to a problem and think the problem will go away. I think we need to be a lot more innovative in how we deal with our social spending budget.
Yeah, that's interesting. Michelle, I want to bring you in here, and I want to stick to sort of this tax conversation. A 1% drop in corporate income tax. What do you see that does to the bottom line of businesses, especially really large businesses like the one you're in? Do you see more shareholder dividends being declared, or do you see more jobs being employed with some of that reprieve that businesses find, or do you see employees getting a pay raise that is substantial this time around?
I think that's a great question, and it leans to what John was just referring to now. It's about making South Africa corporate friendly, because we're really not going to be able to get out of the situation South Africa's in now by paying higher social grants. The solution sustainably is making more taxpayers. You really want to increase your employment base, and the best way to do that is through corporate South Africa. So I think sort of doing things like reducing the income tax or the corporate tax does mean it makes it a slightly friendlier space for corporates to do business in. And that means that essentially it hopefully will mean greater employment. But the critical thing with all of these is about sustainable greater employment. And I think that a lot of the mention around in the budget speech around making it easier to do business, making it easier for smaller companies to do business are big areas where essentially if we can get that successful, it does mean that there will be less dependence on the social grants, or in the long term, in general, social security.
Dr. Stander, does a tax relief both for businesses and households mean that the organization you work for will see greater compliance from households? Because you only survive if ratepayers are compliant, and now they have a little bit more disposable income. Do you see an increase in compliance coming as a result of that? We also now know, because of Operation Twaneyatima, that businesses have not been compliant. In fact, it's been shocking figures around how large organizations have not been compliant. Do you anticipate a pattern of greater compliance emanating from this reprieve?
Oliver, immediately, I don't think so. Right? It's a perception or a social culture within South Africa, right, to want to spend too much money. And I think both John and Michelle will be able to attest to the undersaving, the persistent or endemic undersaving of South Africans. So I don't think suddenly households will save more money, but our local governments will respond. We now know there are more money in people's pockets, right? So you might even see increase in intensity of campaigns such as Twaneyatima, because we know people have money. I think these type of campaigns typically should fall within a social compact between government and businesses and government and residents, right? And this is what's lacking, and you'll see a lot of market commentary talking around a social compact between government, what government's supposed to do, and what our responsibilities are, and what taxpayers and residents' responsibilities are. And I do think that the pressures on local government has not been adequately addressed within the specific budget, which will of course put pressure on municipalities to increase the intensity of debt collection efforts and trying to squeeze more money out of our ratepayers who are municipal residents. So the budget, although it's been dubbed a very neutral or a very positive or a very balanced budget, I specifically think it was a fairly lazy budget, because we are unfortunately in a global environment where we need to make very tough trade-offs. And Michelle was alluding to that, and John, the listener or the caller on your program last night had a point, and it's not essentially in the principle of should we be extending these social welfare packages. I think it's more in the design of those packages, right? So we essentially we are extending grants to almost 28 million people in South Africa. So 18 million that's on regular social welfare packages, and another 10 million that's being covered by the COVID specific grant package, right? And I would like to see National Treasury designing those grants to also start enforcing the payment culture in South Africa. So yes, you get a 350 grant, but can you pay 50 Rand to your local municipality where you are consuming services, right? Because you know, on top of the very extensive social welfare package we run, I think the minister said it's 60% of our MTREF. What they call the social wage. I would have liked to see that as a productive or an economic wage rather, because we need growth in the country, and we'll discuss a bit later on about the growth predicament our country faces. But as long as people get money, even if it's 350, right, you are then able to contribute towards the municipality where you are consuming services. And 50 Rand doesn't sound a lot, right? But if you think of 500,000 people in Tshwane earning 350 Rand from a COVID grant and being able to contribute 50 Rand towards the municipality, right, that's a significant increase in our revenues, which obviously allows us to spread the pressure and spread the responsibility and the tax burden amongst our residents better.
That's an interesting perspective. You know, last night, Old Mutual hosted the Minister of Finance at the budget speech competition, and just as the minister ended off his address, responding to questions from some of the students, he made an interesting comment which really stuck with me. It says, in South Africa, we haven't experienced inclusive growth by including people into the economy. So what we're doing instead is compensating them through social welfare for excluding them out of the economy. And you talking about a productive spending instead of a social wage spending is an interesting, complement to that sort of thinking. Sort of before we go on, and I want us to wrap up the tax conversation here before we speak about sort of important reforms taking place coming out of the budget. There's an interesting question I received here, Michelle, and I'd like you to go for it. One of the participants, or one of the audience members, just asked a question around corporate income tax, and the question is, if corporates are taxed less, where will government get that back? And I guess I'll supplement that by saying, the government suddenly fall into a big pile of money that they can now start saying, hey guys, we don't need any more of your money, we've got our own now. What happened?
So I think it's a balancing act. It's like when budgeting, you've got your income and you've got your expenses. So essentially, in terms of the reducing of the company's tax, the one aspect should say that should promote economic growth in some ways, because it puts more money back, which then means more companies will be successful, which means there'll be more companies paying less tax, if you know what I'm saying.
Yeah.
So I think a lot of it is around that angle. And it's also around in general, I mean, SARS and the whole collection around tax. But the big thing is, the more they can stimulate the country, the better the country does, the better companies do, the more tax that is paid, and therefore the more income that's got. So it's that balancing act. If you tax companies too high, then it puts a lot of pressure on them. They don't do as well, and vice versa. So I think it's really one of those where the net effect, if they can reduce the tax rate, will mean that companies, hopefully, it does create the stimulation and other mechanisms as well. So not through just reducing the tax, but there's a lot of other mechanisms that have come through in the budget to try and promote the private sector, bringing in more companies, small businesses, etc. And hopefully then there'll be an overall increase in income at the end of the day.
Yeah. A big part of this, reprieve on tax is to give relief to people and businesses and households recovering from the pandemic. Michelle, one of the big announcements last night was around an amendment to Regulation 28 of the Pension Fund Act, and that seems to be a response once again to allowing households to access a little bit more money than they otherwise would have as part of our recovery project. And talk to me about that amendment to the Pension Fund Act. Tell me what that means for households. We now know from the minister that next month from there, it means that pension funds will function a little bit differently after that. Two-pot system, the minister said, right? Can you explain to us what that looks like and what that means?
Okay, so I think there were two aspects that really came out around retirement funds. The one was the Regulation 28, and that really is around the investments of retirement funds. And that focus is very much around focus on increasing the infrastructure allocation that you can invest in retirement funds. And there was also an overall increase in the offshore allocation. So that's around the investment side. The other element where there was the changes around the two-pot system, and in terms of really fundamentally changing our retirement fund industry. And maybe if I can take a step back to the question of why would they be looking at doing this? So I think if there's one thing that we realized, and especially through COVID, is that the majority of South Africans, the only savings they actually have is their retirement fund savings. And in our current regime within South Africa, there's also this culture of, I might save in a retirement fund because I'm working for an employer, but the minute I change jobs, I can cash my pension fund out. So what people end up doing is they cash out their pension fund, join a new employer, start saving again, and go, look, I'm saving for retirement. Now, the problem with that behavior is twofold. Firstly, it means that actually these retirement funds you're only saving short term, and we know. But the other challenge is it means that a lot of people are beginning to feel like they need to leave their employer in order to access their pensions because they're in financial difficulty, etc. So with those as the backdrop, what the two-pot system is trying to do, and I think just to proviso, it is very clear that it's looking for future money only, so it won't impact current funds. So current funds, current rules and regulations, current what you can do doesn't change. We're looking at going forward. But essentially what they're looking at is saying in the future, your contributions that you pay into the retirement fund, a third of it will go into what we're going to call an accessible pot for now, and 2/3 will go into a non-accessible pot. So it's still within the retirement fund structure, but you'll have these two pots in the fund. Now, the first fundamental change is that non-accessible pot. So that 2/3 component will be locked until retirement. So there will be no more the ability to access that 2/3 before you reach retirement, which stops this habit of changing jobs and cashing out. So that's the first big change. And that's going to have a mammoth impact on people's retirement savings, because we know this cashing out of your pension fund every time you change jobs means that when you get to retirement, you don't have enough money. And what does it mean? You're dependent on the state, you're dependent on family and friends because you can't retire comfortably. So locking in that 2/3 with compulsory preservation into the future will, over the long term, have a massive impact. So that's the first element. The second element, and the part that's probably getting the most noise, is around the 1/3 accessible part. And what they're looking at doing and saying is that actually we should not be linking accessibility, because at the moment we have 100% accessibility. All you need to do is change jobs. What we're trying to do is remove that accessibility linked to changing jobs, because actually the two don't tie together. And so the idea is this 1/3, and it's an advance almost on your 1/3 cash you can take at retirement. And they're saying you build that up over time and you're putting your money in. But if you come up with an emergency, if we have a COVID 2.0, then you now have ability to access that 1/3 component if you need it. So what it means in principle is that any person who's going to be a member of a retirement fund moving forward will always have their secured savings. That's locked in. We know that's going. That's the 2/3. And then they will have their other portion of retirement savings, but they can access it if they need it, but not linked to retirement fund exits. So i.e., if I now have an issue where I have a financial difficulty, death in the family or whatever it might be, and I need money soon, then that will be able to be accessed. So there will be rules around that accessibility, which we're still waiting for the proposals, and they've said legislation will come out in the middle of the year around that. But essentially the idea is that that will then be the pot that you can use as a rainy day fund. And let's hope we don't have, it's not intended to be rainy days every week or every month. The idea is practically it'll work well if you have a rainy day once every 5 years. But if you don't touch that accessible pot, so you leave it alone, that is your lump sum at retirement. So the idea being that whatever you don't spend of your accessible pot, then when you get to retirement becomes your lump sum. But if you get to retirement and your accessible pot is empty because you've needed to use it, then you don't get a lump sum at retirement. But what you do get is that 2/3 non-accessible pot value to be purchasing as an annuity, which means you will still have the income security after retirement. So that very briefly in a nutshell is what this two-pot system is referring to. And if I can, Oliver, just make one other point, is there's also been a lot of noise around immediate access. So can I have access to my current retirement funds now? And I think there's a lot of misconception around what that intention is. What does now mean and how much am I going to get? So I think at this stage, it's very proposal stage, but they're only looking firstly at enabling an access to a very small portion of existing savings. So the number that was being thrown around in the proposal document that was released recently was 10% of your fund value capped at 25,000. So that is, it's not in a massive amount. I know that there's been numbers thrown around of I'm going to be able to access all or 1/3 of my existing pension, not at all. So I think it's important to note that it's only a small access. The second thing around that immediate access is it can only happen when actually the laws are changed and the regulations change. So it's not going to happen next week. It's not going to happen next month. So don't start planning your financial solutions just on this portion. It's actually going to take a while. So they mentioned in the budget speech yesterday, they're hoping to release draft regulations by the middle of the year, by June this year. So that's step one. So we see the draft. We then have to have comments. It then goes through a process. And only once legislation is changed, then can the administrators, retirement fund administrators, actually start getting their systems ready to process this new world. So it's something that will be happening in 2 to 3 years from now. Let's hope it happens as quick as that. But it is also not massive amounts. And it looks like in terms of the wording, especially that was released yesterday, is around they're going to be giving some discretion to pension fund trustees as to whether they will allow it. Now, I promise one more point, because this I can carry on for hours and hours. Anyone who knows me knows this, is this will impact not just pension and provident. So the two-pot system they're referring to is going to impact all retirement vehicles, retirement annuities, preservation funds, provident funds, pension funds. So the idea is that the whole system moves into this two-pot world into the long term. So this accessible pot will also be applicable to retirement annuities in the future.
Yeah, you mentioned there at the tail end that discretion will be given to trustees. And last night at the budget speech competition gala dinner where Old Mutual hosted the minister was very, very, very clear about that particular point, making it clear that it's not for him to decide who and when people get to access that money. It is really up to the trustees deciding if they're going to open up the pot, how much of it they're going to open up, and under what circumstances they're going to open that up. But John, Michelle speaks about a rainy day, and I'm assuming the trustees are going to have to define to themselves what a rainy day looks like. And in South Africa, we don't run out of rainy days. So it's really for individuals to decide what that looks like for them. What's a good filtering system as a household to decide, is this a rainy day moment so grave that we have to dip into this retirement fund pot, or is this something that we can just weather the storm, so to speak, and come out a little bit scathed on the other side, but at least we still have substantial retirement savings, what does that look like? A rainy day. Talk to me about that.
No, you are very right. Firstly, South Africans are capable of creating their own rain. So when you talk about rainy days, is a very dangerous term for a South African because we can create rain any day. So I think, I think we also need to be creative on how we define what a rainy day looks like. For me, when somebody gets summons, in respect of any debt they have, for me, that's a rainy day. Even though you could have, it could be self-inflicted, because a lot of times, credit providers don't just send you a Section 129 letter of demand. It's because there's things that didn't happen, that should have happened, but in that way, you've created your own rain in that way. But I think those are other circumstances. Or if a person says, I think, look, it's difficult to be prescriptive in terms of what that should look like, but I think maybe a consultative process can be useful. But I quite like what the minister did there, because I think I saw what he did there. He made a U-turn, from the tone of his predecessor, by saying, no, this is not our decision to make, and we'll rather empower the trustees to make that decision. And I think it's a good thing, because let the trustees make their own rules, and the rules from one fund can differ from the other fund, because you also have to take how the different funds are performing. So yeah, I think those are things that we need to be looking at to say, what a rainy day looks like, because rainy day could mean different things to different people.
Yeah, I've got a question here, John. Someone in the audience asking, is government really wanting to promote household savings because they want to give people access to the retirement fund to help alleviate existing financial pressures, and yet the tax on savings products is still quite bad? CGT, I don't know what CGT is, you guys can tell me what that is extremely high, and at a 45% on shares as an example, is really high and not worth saving and investing. Also, a tax-free savings ceiling is still rather low if promoting savings is sort of a goal. A retirement fund is effectively a really sophisticated stokvel with rules where savings is, always going to be the fundamental goal. Is government really trying to promote savings if they're giving people all of these sort of regulatory adjustments to be able to dip into those savings, but not really lifting the ceiling on, a tax-free savings account? And do you think enough is being done in that space?
And look, I don't think the idea is about promoting savings, because the retirement fund itself is a savings and investment vehicle, if you like. So, because how do you say, okay, you are saving, but you are giving me money to go and spend somewhere? So that's definitely not for saving. But I think it came as a result of the pandemic, because, and I think Labour has been at the forefront of this debate to say, but please give, give access, to workers, But it's because they saw the ravages of the pandemic, and they said, look, in such instances, what happens when a person's income has been halved, like we've seen? What happens if a person is not allowed to trade because of lockdown restrictions and things like that? You know, those could be potential example of an emergency situation. So it is meant to help people in distress circumstances, you know, to be able to try and deal with that. I mean, you recall the banks also came forward and said, no, look, we'll provide some kind of, you know, relief in terms of debt, where you can arrange to skip maybe 3 or whatever the case may be. You know, it's because everybody was trying to find ways to cushion the blow on everyone. So this was meant to cushion the blow in such circumstances, not to go and buy a German car. You know, so apologies for those who drive a German car. It is certainly not for that.
Can I also just come in on there?
Sure. Go ahead, Michelle.
I think what's important to realize is I know that they're discussing, and it's still very early stages, about employers or the trustees being able to assess if they're going to allow access or not. I think there will be some guardrails put around that. I can't imagine it'll be carte blanche. So it'll be the sort of thing that says it can only be allowed, but if up to a maximum of. So I almost think that that discretion is not how much, it's going to be yes or no. So, and I could be wrong, but I don't think most people must get excited and go, okay, so my fund might let more than others, because it's a very competitive market out there as well, and market forces will start also driving bad behavior. So I really think it'll be the sort of situation that says, actually, funds, trustees, you can decide if your fund is such that it can allow for this or can't allow for this. But if you do allow, it'll be up to 10% or whatever the number is, because we also, for that exact reason, we need to protect. Retirement funds are there to save for retirement. So they are looking at how mechanisms can be put in place to protect against situations like COVID. And I think that's the other thing. There was always belief that this is going to fix this COVID. So the access is going to be for now, because now's the problem. However, changing something structurally as big as the retirement fund industry can't happen overnight. It is actually a hell of a mammoth job. And so the idea is we've learned from this. We've learned from COVID. Most of us hopefully will never experience another COVID in our lives, but we've learned from it. And because of that, we've seen what we need to do. And so hopefully what that will also do is encourage savings. The other point we didn't touch on is the retirement annuity space, because just like John mentioned, there's a lot of people who self-employed, so they're not part of a pension or a provident fund, but they're actually on their own retirement annuity fund. And those retirement annuity funds have a zero access rule before retirement. And so you had a lot of self-employed individuals who had money in an RA, but no money else because their business cost and earning an income, etc. And so the idea is moving forward, there won't be complete 100% lock-in and you can't touch your money. With this new two-part system, it will mean even people in retirement annuities will be able to access a small portion of their money if they need to in case of emergency. But just on your point, you asked about the savings element and are we encouraging savings? I think the challenge in South Africa is we've got high levels of unemployment. The income disparity is huge. The average salary is really low. So there was a big drive a few years ago, and I'm sure most people are aware, about tax-free savings accounts. If we just open tax-free savings account, more people would save. Well, we've seen, no, that's not happening. So I think it's more than just creating the environment to save, because average South Africans often at the end of every month, aside from the fact that we're terrible savers and we'll find much more money to spend.
Do you think it's a culture problem, Michelle?
I think a lot of it is a culture problem. I think in South Africa, we're renowned, we're very poor savers by now. You know, if you have 500 Rand at the end of the month, you don't go, which savings account should I put it in? It's, okay, where do I go spend it? And that's really something that I know John works quite closely with, trying to educate people to try and realize that you need to change that mindset, but it's not going to happen overnight. And it's the sort of mindset that you actually need to try and find ways to legislate or put rules in place to force people to save. Because if you ask people to do it voluntarily, we've seen it doesn't happen.
Is it because John's dad told him it's the last 50 Rand every time he needed 50 Rand? Michelle, do you see, and just before we move on, because I really want us to tap into the space of what a rainy day really looks like. And I think we need to, build a lot more insights around that. But do you see this legislative reform change to retirement funds? Do you see it disincentivize a lot of people away from early retirement. And the compounding impact of that would be, do you see greater productivity as a result of people not taking early retirement?
So I see that these changes in the long term, what it's going to do is mean that members are going to be forced to keep a lot more money in their retirement fund than they currently do. Okay, because yes, there'll be this portion of accessibility, but this portion of accessibility will only be for a third. So the other third, so what it will mean, and I'm fast forwarding 10, 20 years from now, because this takes time, money doesn't happen overnight, but it will mean that there'll be a lot more people who will be able to retire at retirement age and afford to be able to survive on their savings after retirement. So that's going to have a big difference. So I don't necessarily, often there's this perception of how much you actually need when you retire, and this early retirement concept, it can actually cause a lot of harm to somebody's financial position rather than promoting it. But I really do see a fact that if we go into a process where we have compulsory preservation, in 10 and 20 years, as this rolls out, you will begin to see more people, more pensioners self-sufficient, which means there'll be less dependence on you'll be less of this sort of sandwich generation type concept. But I'm not sure what it'll do in terms of people early retirement versus normal retirement, but I do think it'll give people a lot of hope that they will be able to afford to retire in the future, where some people don't have that hope at the moment.
Dr. Stander, John speaks there about, I asked him, what's a rainy day? And he says South Africans are capable of creating their own rain. But then he says, an example of a rainy day is when a creditor runs after a debtor for defaulting. I don't know organizations that has more defaulters than local government, depending on collections. Do you imagine with people being able to, as debt defaulters, being able to access that sort of money to take care of that debt because you now received legal documents and notices? Is that an instrument you're looking to exploit, hopefully to get people to be a lot more compliant?
Oliver, personally, I don't think we should even go there as local government, right? I don't think what most South Africans view as a rainy day is actually a rainy day, right? Death in the family, you can plan and save for that, right? I'm quite sure Old Mutual has many instruments you can access to mitigate against these future risks. But some of these risks are more realistic, and you can actually plan for them. Your child going to university, right? It's not a rainy day. You've known about this for 18 years. There's enough adequate time for you to plan and save for these events, right? I think Michelle hit the nail on the head. Something like COVID, right, which nobody could foresee and which you typically couldn't plan for, and that placed a lot of exogenous pressure from external to the system on your cash flows and on your finances, right? That certainly can be seen as a rainy day. Your relationship with local government, it's a continuous thing as you enter of age and you start contracting with government, right? Certainly a debt default cannot be a rainy day, right? It's bad planning. And I think we also need to protect a lot of savers against their own inefficient planning, right? Because what's happening, and this is my concern with these reforms introduced within the retirement space, somehow you also signaling to consumers that there's an incentive for them to forego savings to consume in the current period, right? But they don't have a good understanding of the discount factor of not being able to consume in future. And it also pushes the discussion to, should we have this fixation on retirement? I see many productive people age 75, 80, still working, still plying their trade, still doing things that makes them self-sufficient, right? Now, I'm not saying they shouldn't save. I'm saying as South Africans, we have this perception that we must work, save until the age of 65, and then go and sit and do nothing and retire. And I think, through financial education programs, we should also change that perception, because you should typically work for as long as your body and your health permits you to work. And I would really not see the local government forcing savers to actually have to access the accessibility, the third portion of the pension or savings funds to settle debt. These things should be addressed through good credit control policies and through having a social compact with our residents and our businesses.
Yeah, I think we had lost Oliver for a moment. I think he's back.
Yes, I am back. I hope everybody can hear me. Just wave if you can actually hear me. Okay, I'm so sorry about that. Sometimes technology fails us. But I did catch the bulk of your answer there, Dr. Stander. Look, there's a ton of questions people have about savings and retirement. And a recurring question, Michelle, that I think we need to settle here is that a lot of people are asking, will the portion that you can take as a cash lump sum at retirement still be tax-free? Will the first, applying to the first 500K, or is there a change to that as a result of this amendment?
So that's a fantastic question. And I think just so everyone's aware, as part of these proposals that came through, and remember we are still at proposal stage, was around looking about the tax treatment of this change and how the two-pot system will work. So they are looking at a number of options. As Old Mutual, we are recommending that they do not change the current tax regime. We do believe it's an exceptionally effective tax regime. We think the tax deductibility of contributions is hugely powerful in encouraging people to save. And we can see that, for example, with the 350 cap. You know, when they brought in the 350 cap, all of a sudden people stopped contributing above 350. So in South Africa, with the tax regime where the money goes into tax-free, it doesn't earn tax when it's in, and the tax comes out at the other end, that regime works really, really well. So we're encouraging that it will remain unchanged. Assuming it does remain unchanged, then what it will mean is, yes, any withdrawal out of the system before retirement, so if you're accessing your accessible pots before you reach normal retirement age, it will be treated on the withdrawal tax tables, right? So so that won't change. And then at retirement, of course, depending on how much tax you've taken or how many withdrawals you've taken, that any lump sum you then take out or what's left in your accessible pot of retirement, yes, then the 500,000 tax-free would apply. So at this stage, we as Old Mutual are pushing not to combine changing the two-pot system and having fundamental reform to your pension system, and then combining it with a change in your tax system, because I think it'll create a bit of instability, and we've got a very, very strong tax treatment of retirement funds, which we want to maintain. So at this stage, it's still a proposal, but that's really what we're pushing for as Old Mutual.
Look, Dr. Stan, I want to come back to you. A lot of this conversation really is just about providing instruments for households to survive tough times, right? And we hope that they use this wisely for tough times. But it leaves me wondering just how many households find themselves in these tough times and in sustained tough times, right? And I imagine you more than anyone on this panel has an overview of the financial state of a lot of households, through the City of Tshwane's rate collection program, but also through their indigent program. Do you see more and more households signing up and approaching the city, one for payment arrangements as a result of default, and joining the indigent program, in the purpose of reliance on free basic services? Because that will give us an idea around how many households are so distressed that they might start abusing the avenue of this first pot that they can start digging into.
Oliver, we definitely see, and we have seen an increase in the last 2 years on our indigent register. Right, so there's specific criteria that's set by different local governments or municipalities on how we view or how we classify a household as being indigent. And as part of the indigent relief, we offer them a parcel of free basic services, which for the City of Tshwane, for instance, is 100 kilowatts of electricity. It's 12 kiloliters of water. It's free sanitation and free refuse removals, and obviously a full 100% discount on the property rates side. So over the last 5 years, I think we've seen an increase of 40,000 households coming onto our indigent register. So to give you an idea, we have about 1 million accounts in the City of Tshwane. So those are households having an active account with the City of Tshwane for rates and taxes, for utility bills, and 140,000 of those are on our indigent register. So to put this into perspective, the value of the parcel of free basic goods and services that we give to indigent households is about 750 Rand in this case of the city of Tshwane, right? It doesn't sound that much, but multiplied with 150,000 households, you quickly discover that indigent extension or social relief through our indigent program is costing the city north of 110 million Rand a month. Now, the reality in the South African context is somebody has to pay for that. And who's paying in the City of Tshwane context? It's City of Tshwane ratepayers, who essentially through paying their accounts on time and in full are essentially subsidizing and making significant redistribution contributions into that indigent household pools. We've also seen an increase in the recurring indigency. So our policy allows for a 2-year period that a household can actually be registered on our system, and then they have to be exited. But what we are seeing is there's a lot of them that reapply for registration onto the indigency register. And it brings us to the savings and the culture that we are observing within South Africa, right? We should be very careful not to tailor much needed interventions in such a way that it creates a dependency on those interventions. A lot of these social interventions are supposed to be temporary in nature, right? And I think no one, there's not one single, whether it's a liberal economist, whether it's a new classical economist, whether it's a free market proponent, no one's going to argue against the fact that we have to provide extremely vulnerable households with a temporary relief so that we can actually extend that social net to them. But what quite often happens is the design and the value of this extension and the social net, right, becomes way too comfortable for South Africans to find themselves in. And hence, when you face a market where there is a shortage of jobs, where there is a shortage of stimulation emanating from both our monetary side of government, because monetary policy, like the Reserve Bank governor will tell everyone, is not there to stimulate the economy, it's there to protect the value of the currency. But in this budget that Mr. Godongwana tabled yesterday, we also see very little stimulus for the economy. So if the monetary side of government's not stimulating the economy, the fiscal side of government's not stimulating the economy, you have to ask yourself the question, where does the stimulus come from? And I think President Ramaphosa, during his State of the Nation address, he hit the nail on the head to say, but it's businesses that are supposed to be creating jobs and not government, which is a vast departure from essentially the ruling party line that they've maintained for the last 27 years, right? What you would have expected in this budget is a real commitment and a realization of that pronouncement. And I was expecting hundreds of billions of rands in the budget to be allocated towards stimulating the business environment. Now, obviously, you have seen the decrease in corporate taxes, which acts as a stimulus, but you haven't seen enough direct stimulus into investment and productive economic activity that you can really say businesses are now enabled to create jobs. The environment has become more conducive for them to create jobs. So we'll keep on seeing the most vulnerable communities in society, right, flocking to cities. I mean, the urbanization trend is very well documented, and we're seeing it in cities, right? And we have to also ask the question, the way in which government actually funds local municipalities, right, is through something we call the Division of Revenue Act, embedded in that DORA. Local government especially loves acronyms. So embedded in DORA, there's a local equitable share formula that essentially accounts for the size of your population, the type of services that you render, and the number of councillors that you have. The proxy that they use is the number of councillors. So if someone was wondering why municipalities keep on employing more councillors, it's to essentially get some higher allocation in the local equitable share. But the way in which this is funded essentially doesn't allow local governments, right, to give significant relief to customers who are engaging with us at the coalface, where we can see these struggles. We can see it in the time they take their bill, pay their bills. We can see it in the percentages on a monthly basis of people receiving their bills and paying immediately. We are seeing an increase in how long it takes regular households, and this is across townships, across rich suburbs, across business and industrial parks. And people are, and our earners, income earners in the country are under pressure. And I have to focus on that because we already know we have high unemployment. We already know we have this vast dependency on receiving grants or some social assistance from government. But we also have to realize that the taxpayers that are actually able to pay taxes are also under extreme pressure. And the budget, and that's why I called it a lazy budget earlier, because the budget did not pronounce enough radical stimulation into the economy that will actually see us embarking on a higher growth path.
Let me ask you this, because you guys started Operation Zwane Yatima, which is possibly one of the most hilarious things to have witnessed on Twitter. And in large part, it was a depiction of the city going after businesses. Talk to me about how much money you guys collected from the businesses you went after, but also then tell me what that looks like on a household front. Are you guys also increasing your collection efforts at a household level?
So yes, the program led by our city manager and our executive mayor first started prioritizing collecting debt from government departments firstly, who we all know through every year's budget gets enough allocation to actually pay the municipal accounts. We then focused on large businesses, and as you observed, Twitter was very happy for us to be cutting the Sheraton and to be cutting these big businesses, right? That everyone said, yeah, it's good, big business must pay. We do have a very targeted program on residential estates. So for the last 2 weeks, we've been going around the residential estates, golf estates, lifestyle estates, suburbs, cutting people that owe us a lot of money. The question, and then we started seeing public sentiment change a bit, right? So people were supporting the initiative when it was big business suffering, right? And then they became slightly more quiet when it was suburban activities being impacted. The unfortunate reality is people quite often, especially during COVID, right, they have this perception, and I suppose it's because they view utility bills and rates and taxes as a grudge purchase, right? So they think, local government, provincial government, national government is in the position to act as a shock absorber, right? To carry households and to carry businesses during times of cash flow challenges. And the reality is we aren't. So I think it's important for your listeners to understand what a budget is and how a budget works, right? And a budget is merely a planning tool. It essentially tells you what government is planning to do based on the data and the estimates the data it has and the estimates it generates. So if we collect all the taxes that Minister Godongwana is planning or estimating we collect, this is how they'll spend. The same thing applies to local government. Local government publishes its budget, it engages with the population, and it says, if we collect these revenues, then this is how we're going to spend it. What happens and what have been happening over the last 5 years, we are not reaching those revenue targets because households and businesses are under pressure, right? And if we don't collect those revenues, we have to adjust our expenditure downwards, and which essentially means people living in the city of Tshwane and living in municipalities suffer because they don't get the services that they thought they were going to get or that they required to get. They don't get the roads, they don't get the amount of electrification, they might not get the quality of electricity. So that's aside from Eskom as a bulk supplier's specific challenges. So people should realize that a budget is a planning tool, right? The budget has to be funded, and for municipalities, those funds are primarily generated by our own revenue collection. So, yes, please.
So I just wanted to ask, John, what do you do at the moment the city of Tshwane is at your doorstep and they say, my man, you owe us 60,000 Rand in services and you really don't have. 60,000? Or what do you do when you see them cutting your neighbor and they're yet to get to you, and you know you owe them 60,000 rand, but you just sit there quietly praying that they just skip your house?
Look, they won't visit you without you being aware that they will come. Because before they get to that point, they will issue with a notice. So the problem is what we do with notices that we receive, and not only notices for water and lights, but generally South Africans sometimes tend not to respond very well to notices, private calls when they know they're in trouble. So it's almost like the ostrich syndrome of burying our heads under the sand and hoping the problem will go away. So I mean, when the city gives you a notice or they show you an areas, and in fact, even before they disconnect, they will send you a notice that they'll disconnect within a certain number of days. And that's the opportunity you have to approach them to make an arrangement. What I do know is that municipalities do listen when you make representations and make an arrangement to pay it on terms. I mean, I do know quite a lot of municipalities are open to those kind of conversations. But the problem is when you don't communicate and you keep quiet. And that's a universal principle when as far as anything that has to do with you owing something. You know, you can't just, you know, I had a story, by the way, from maybe let me not mention which municipality. We were talking to the wellness manager there, and she told us that one of their employees came to complain that they are in so severe financial constraint to a point where the mashonistas are looking for them. So they come to work at different times. They don't come at the same time. They leave at different times. They don't knock off at normal time. When they get home, they lock the gates. They close the curtains. They never switch on the lights, even at night. So, I mean, that's how serious the issue of indebtedness, which includes people owing municipality. But it doesn't just get there. It starts with people not responding to notices.
Yeah. Michelle, you know, there are a range of products in the market, and oftentimes, and I know a lot of John's work is educating people about these sort of products around that they can, you know, exploit for their financial well-being. Is there a lot of creativity in helping in innovating more products and instruments to really help people around these sorts of things? You know, being able to take care of your you know, I know my mom, for instance, had an education fund for me, which didn't yield much because not much went into it, but there was a little bit something, you know, by the time I went to university. Are there products being innovated around the space for exactly these sorts of things that we're speaking about, not being able to pay your rate and taxes? You know, we plan for funerals and maybe even weddings. There's one institution that had a Lobola fund, a Lobola savings fund at some point, you know, and that for me was an interesting innovation. What's happening in that space?
So I think there is a lot of innovation happening in this space, and there's a lot of range of products. And I mean, they could always be better and things could always be even more innovative. And that's hopefully, I think one of the aspects that will create greater innovation is as we expand the digital footprint of South Africa and being able to give people better accessibility, because I think that's one of the challenges, especially at the lower end of the market, is actually being able to find low cost products that are accessible and easily accessible to individuals. But in saying that, I think one of the biggest challenges is, and I see a couple of comments in the questions as well, is around the fact that with a lot of these savings products, it's not about the product design. It's about how much you put in. So you mentioned your education product you had, but your mom hadn't put a lot in. So therefore it gave you something, but it wasn't massive. And savings is exactly like that. You only get out of a savings product what you put in plus interest or investment returns. And so if you're only putting 50 Rand a month, in a year's time, you're not going to get 5,000 Rand out to settle your bill. That is a lottery. We don't sell lottery products. And so just like anything, it's about creating, and it comes back to a couple of comments as well, and John's mentioned it, education, because there are lots of products out there. But with anything, the best way to take these products out is in advance in terms of planning and not retro. Because if you sort of plan and go, actually, I'm going to be putting X Rand amount in a savings account so that if anything does go wrong, I've got something in place, and you plan that in advance, then it makes it a lot easier, and you're earning investment return on that money or interest on that money. The challenge is, as South Africans, what we end up doing is getting into this vicious spiral, because we get into trouble. What do? We jump over to short-term loans, finding a way where you're actually being charged ridiculous levels of interest, and then it's the cycle that never ends. So I think it's critical that there are products out there, but they're only going to work if people use them and plan in advance. It's like your retirement savings. You know, the only money that goes into your retirement savings is the contributions that are paid in plus investment return earned. There's no magic. It's not like if I put 100 Rand in today, 200 Rand tomorrow. And so there's a lot of discussions around what happens if my rainy day fund is empty, or if I don't have enough money for retirement. It means you haven't put enough in. And so that's part of the planning component. It's absolutely critical that when it comes to these sort of conversations, there is no quick fix for getting into financial difficulty. But there is a lot of processes in place that if you plan in advance, or even when you get to plan properly and communicate, like John mentioned, to actually get yourself out of it. And it doesn't happen overnight. It takes time.
You know, I was having, Michelle, a chat with your boss a night or two ago, specifically around the retirement fund thing. And you know, Ian raised a very interesting point here. He says South Africans really aren't thinking about, because we don't think long term really, we don't think about the compounding effect on our savings and by extension our retirement fund savings. What's the best way we can illustrate the compounding effect of it? Because if I'm going to dig into my pot one or my, you know, the pot that allows me to dig into it once every other month, once every other year, if I run into some financial troubles, right, I diminish the compounding effect that it otherwise would have had if I had just, you know, left it at that, and it grows at a compounding rate over time. What's the best way we can illustrate this so that someone can really understand why it may be, if you may have access to it at a regulatory level, but you really should not touch it unless it's a life and death situation?
So Oliver, I think that's the $1 million question, right? Because if we could really find out to demonstrate how powerful compound interest really is, it's I think somebody made the comment that it's probably it's the seventh wonder of the world or something in terms of how powerful compound interest is. But just to put it in perspective, you're 100% right. Most people, especially when they start work or in their 20s and their 30s, retirement's so far away. I've got more important priorities right now, right? I've got priorities around school fees. I've got priorities around my municipal bills. I've got priorities around rent, etc. Food on the table. I can't focus on retirement now. I'll do it later. But the bottom line is what people don't realize, and I think this is often for me the best way to put it in perspective, is you often, if you're blessed, you work 40 years, right? Let's just go traditionally. You start working at 25 and you stop working at 65, 40 years of working. When you reach 65, okay, what is your life expectancy? When is your date of death? We don't know. And to be honest, we all know someone in their 80s and sometimes in their 90s. So that means you're looking at 20, 25, 30 years in which you are in retirement. And so what happens is we only save a portion of our salary every month. No one saves massive amounts. So let's say we're saving 10% or 15% of our salary every month. You need to save for 40 years to make sure that when you reach retirement, there's enough in there to keep your salary going for the following 20 or 25 years. And so if you expect to save 10% of your salary for 10 years and then expect it to last you 30 years after retirement, I think you can see that the maths isn't going to kind of work there.
And so, human beings live much longer these days, right?
Exactly. And I mean, I saw some comments around the questions around retirement ages, and we should be putting them out. And I always smile at that, because I'm a full believer that one should be working till 75, but let's not go there, because it does mean that you're going to have less time in retirement and more time to save. But the bottom line is the power of compound interest means that if I save for 40 years, just 10% or 15% of my salary, okay, that's not a massive amount. After retirement, I could live on that for 20 to 30 years without a reduction in my standard of living. And that's the powerful part. But it won't work if you only save for 10 years, because then you're going to have very little to save on. And so it's really, I mean, and the other point I just wanted to make, especially when it comes to retirement savings, it's a fantastic place to invest, because first of all, it's really low cost. Second of all, it's tax-free. So the money goes in tax-free, it earns investment return tax-free. But it's designed, most of those funds are designed to give you an inflation plus 5 or 6 return over the long term. Now that's a massive compounding. So that's not just a savings account type compounding. That's real growth on your money over the long term. And the power of that ultimately does mean it makes it a lot easier for you to be able to save. You've just got to do it for longer. That's the critical message.
John?
Yeah, I just want to add to that. You know, psychologists have something to say about that when we start thinking about our future selves. So psychologists say, you know, when we think about our future selves, we use the part of the brain that we use when we think about others. So it's like we don't relate to our future selves. It's like you're thinking about someone else. So we struggle to relate with the future. That's why we tend to be so preoccupied with the now and with the challenges that we see in the short term, that, you know, thinking about long term feels like it's going to take a lot of work. It looks like a lot of work for us. And that's why we're lazy to actually reflect and spend time with ourselves to reflect on where we are and where we are going. I mean, if you can ask, from people attending the session, how many people actually sit down with themselves alone, thinking about their future self? Very little of that happens with many of us, because the brain does not encourage that. So you almost have to be conscious and intentional about thinking about the future selves, and thinking about what would happen when you retire. Would you have saved adequately for your retirement? If you are living on a certain amount, what do you think how much you would need when you retire to actually maintain the same standard of living? So these are some of the psychological barriers that we have when we start thinking about the future, but you have to be intentional to actually change that.
Absolutely. Dr. Stan, I've got a question for you from the audience. The question is, our SOEs are struggling. Do you believe the minister has done enough to support them or to articulate the future direction of SOEs? I also just maybe want to supplement that question. The minister last night spoke a lot about shaking of debt weight. And debt weight doesn't just exist at a national government level. Some local government institutions carry some debt weight as well, carrying on processes, programs, and organizations that really aren't contributing to growing the amount of money government makes, but really depend on government to survive as an institution or a program, and not in a social welfare type of way. What was your thinking around the shaking of the debt weight, such as SOEs that are not functioning well, and does it translate across different spheres of government for you?
Look, government has been quite vocal, Treasury in particular, over the last couple of budget speeches, that, the issue around fiscal consolidation. And what I'm happy about is that there's continuation, even when we've had different ministers, that government is consistent about rationalizing some of the state-owned enterprise. I know it's a sensitive subject. It's quite a controversial one, especially from Labour point of view, because when you start talking about rationalization, Labour is thinking, well, job losses, bloodbath as far as that is concerned, quite understandably, because it means they're also going to be losing membership, but not just membership, but then it means many households without an income, or depending on a breadwinner who works in an SOE. But the reality is, from a financial point of view, not all the state-owned enterprise are actually deriving value for government and for South Africa. And in instances where you see something is not delivering value, you have to decide whether you need to keep it or you need to let go. You saw what happened with SA. It was quite a painful exercise. The minute you start getting business doctors to look at the business, rationalize, it's quite a painful exercise, and because people lose their jobs. But the reality again is, you cannot continue to drag something along when you know it's not deriving value. What the minister's tone was telling us yesterday was, government will have to critically look at some of the state-owned enterprise and see which ones they need to keep, which ones they might need to let go. Privatization, again, a very controversial subject, because eventually I think that's where it's taking us. With Telkom, but again, if you look at how Telkom is run now, it's actually a viable business. So which means it is possible to look at some of these things. In fact, even in our personal finances, there may be certain things that we like, that we're paying for them, we're maintaining those things. But if it's not working for you, and if it's a leaking bucket, you have to let go. Whether, Oliver, even if you've got 5 sidekicks where you're spending money, you're sending airtime every month, you have to cut out those things when you see that it doesn't work for you anymore. So I'm just using that as an example, but there are many other examples are things we can do without. And that's precisely what government is starting to do now. And I think for me, it's a step in the right direction.
Dr. Stander, can you take a stab at that question as well?
Yes, Oliver. Look, I don't actually even think it's a contentious issue anymore. Government knows which SOEs are not working. Right? We need to take decisions. We unfortunately, we still see, we are thinking about this. There is a committee looking at the feasibility. I think those inefficient SOEs should be sold, whether they privatized, whether they closed down, but the government doesn't have any business in running those assets. Right? Something like Eskom is slightly more complex because of its strategic nature and the specific characteristics that it endows to the South African economy. Right? So if government takes its time on what should be done with Eskom, we can understand it. South African Airways, sell it. Denel, sell it. We can run through a list of, I think, the 600 odd state-owned entities. If that entity is not making money, which it's supposed to be doing for government, sell it. Right? It's different if you impose conditions on potential buyers to say, please lock in the staff complement here for 2 years at least, give us that guarantee, right, to mitigate the loss of labour function. Because obviously, if you look at the realities, private sector in South Africa has not been a net creator of jobs since 2008. So in that void, right, it's not completely unjustifiable for government to have stepped in and essentially expand the public sector service because of the need to actually create jobs and to create a mechanism through which people can earn money. The question of rationalizing at government level, be it national, provincial, local, as John said, right, we need to find a balance, but we need to find that balance extremely quickly. Even if you look at the very conservative increase in the public service wage, right, of 1.8%. I know there are a lot of market commentaries that say, but this is great, this is a step in the right direction, and maybe it is, right? But for the city of Tshwane, for instance, that translates into us having to pay 240 million rand more per year for the people working in the city of Tshwane, right, government employees, and the 240 million has to come from somewhere, right? Where will it come from? It will come from our ratepayers and our taxpayers. So taxpayers in cities should realistically not be expecting, even though it's a very neutral budget that gave a lot of tax breaks and money back into their pockets, they should not at municipal level be expecting anything less than double-digit increases for electricity, for water and for sanitation. They might realistically be expecting inflation-linked increases for the other services.
I want to touch on that, Dr. Stander, but I want you to answer it, John, because and as we close this up, we've got about 5 minutes left. There's a question here that links to Dr. Stander's last comment there, John, and the question is, how do we save if we have electricity hikes, water hikes, rates and taxes, inflation, medical aid, etc., but our salary increases are way below that? It makes it virtually impossible to save.
Look, I'm going to say something that we've been vocal about over the past 3 years. I think for me, gone are the days where you have to be married to a single income. And the problem now is that, just because the net effect of our wage increases doesn't actually match, inflation, the inflationary pressures, you can't just sit back and say, well, I don't earn enough, and as a result, I'm in debt. But the question, you need to start thinking creatively. I mean, that's what we're seeing globally. People need to be encouraged to look for multiple streams of income. If we are going to make any difference in terms of our savings, in terms of just improving the quality of life. So we certainly encourage people to start being creative and looking at hustling, being in the research that we did recently, we are seeing a strong growth, amongst people who are there's a polyjobbers, polyjobbers, people who have a formal income over and above their main job. So I think we need to normalize having multiple streams of income, because I can't make an excuse that I can't pay my water and lights because my employer only gave me a 5% increase. It has nothing to do with the municipality or your credit providers, but you need to think creatively around, but do it in such a way that you also don't practice moonlighting. So it must be in the context of what employer can allow, but certainly we have passions that are dormant, that we could be sitting on a gold mine, but just because we don't like thinking, we don't want to use this thing to get us out of the rut that we find ourselves in.
Yeah, John, thank you so much for that. Michelle, your closing remarks in 2 minutes. Your closing remarks in 2 minutes. And the question I want you to answer at the end of all of that is: are you positively optimistic about the future?
Yeah, so some just closing points. I think what's really important, or what's really exciting, is that there's some very, very positive changes that government is trying to bring through to the retirement fund space that I think will improve things for all South Africans in the long term. So that for me is massively positive. These changes take time. And so it's important to realize that this is not an overnight fix. But it also demonstrates, I think a lot of this demonstrates the importance of people, individuals, to really spend time understanding all of this stuff. Because otherwise we really do have an ostrich impact where everyone puts their head in the sand and says, I don't understand it, so therefore I'm not going to get involved. But retirement savings is your money. It doesn't belong to anyone else. It belongs to the individual member. The retirement funds are only looking after it for you and investing it. So it's really, when we start discussing access or saving for retirement, you must remember that this is your money, your contributions, you paying it in, and it's to benefit you at the end of the day. And so really, when it comes to that, it's only in your best interest to actually be very, very involved in it. So overall, I'm very positive, but I'm a very positive person, so I'll always come across positive. But I think it really is, we're seeing the shoots of change. We're seeing a lot of the right talk. I think the next step is around having the right actions come through.
Yeah. Dr. Stander, are you positively optimistic about the future?
Always, Oliver, but I'm going to say this with a caveat, and I'll work one of the questions I saw on the chat box into my closing statement. As Michelle and John is every day actively advocating for more active savers, I want to advocate for a more active citizenry. Right? South Africans are extremely lazy when it comes to actually engaging with their councillors and with the local governments and with national government policies. Right? Taxpayers have to start realizing in South Africa their power, right? So all municipalities have to, by law, go out to the public. We consult the public on our budget plans, right? We typically, in a public participation session, which happens around May, we get 200 to 250 comments. We're a city of 3.7 million people, right? South Africans are not interested in the policies and the way in which the money is spent that they are funding. And they have to become active in this, right? The question said, how do we ensure that there's more productivity and better delivery from government? You as the taxpayer have to keep us honest, right? You can engage, you have the right and you have a vested interest in engaging with local government and with national government through engagements with ward councillors, with city councillors, with the city administrations, and with whichever public servant you actually engage with or that comes across your plane of interest and influence. And South Africans really have to start looking at how municipalities compile their budgets, where the budgets will be spent, because those things are detailed in the documents that we engage the public on, right? But a more active citizenry will ensure that things are being done in a more transparent and more productive way that serves them. And that responsibility sits with each and every single South African. So yes, government has a lot of work to do in being productive and actually making sure that we derive the most bang for buck for taxpayers, but equally taxpayers has a responsibility to keep on engaging with government, telling them what they want from their tax monies and actually making sure that they derive benefit from it.
Dr. Stander, thank you so much for your time. Really do appreciate it. Bash John, thank you so much for your time. Truly always indebted to you, and hopefully you and I can chat again pretty soon. Michelle, Your insights have been invaluable. Thank you so much. And Ian was absolutely right. You're quite the expert on retirement fund reformation. Really appreciate everybody. To the audience, thank you very much for everybody that's tuned in. I hope you found this insightful. This conversation, if you missed any parts of it, will be available on my podcast platform, which is available on all your major podcast streaming platforms, Apple Podcasts, Google Podcasts, Spotify, whatever you may be using. Simply subscribe to the Oliver Dixon podcast and you can listen back to this conversation. I know as you were listening to this conversation, you thought about that one colleague that needed to hear this and that one aunt who you wanted to subtweet with some of John's comments around creating their own rainy days. There's certainly someone in your life you'd want to share this conversation with. So as soon as it's up, you can share the link to this conversation, and make sure that we spread the gospel of fiscal prudence as far as we possibly can. Thank you so much to everybody that's tuned in. Really do appreciate it. Thank you to the panelists and thank you to Old Mutual for making this happen. See you guys hopefully next year with a more positive financial position for us all.
Thank you, Oliver. Thanks, Michelle. John, keep well.